Welcome to the Explainer. Today we're diving into some pretty major financial decisions you might run into. We're going to look at some powerful tools for funding life's biggest milestones. Things like a college degree or even a more comfortable retirement. We usually think of our house or our 401k as our big ticket assets. But what if there's a ton of value locked away in places you haven't even thought to look? Today, we're going to explore two very different financial tools and the really important rules that go with them. You might be surprised.
All right, first up, let's talk about planning for one of the biggest expenses out there, education. With college costs just going up and up, you really need a solid game plan. And that's exactly where Section 529 plans come in. They are an incredibly useful tool for families.
So, 529 plans basically come in two main flavors. First, you've got prepaid tuition plans. These let you lock in today's tuition rates for the future, which can be a great way to beat rising costs if you're pretty sure about, say, an in-state public school. But the more common one is the college savings plan. This one works kind of like a Roth IRA, but for education, letting your investments grow tax-deferred.
So what's the big deal with these plans? Well, for one, there are no income limits to contribute. Plus, it's not just for parents. Grandparents, aunts, uncles, pretty much anyone can chip in. And here's a huge plus. If the kid decides not to go to college, you can just change the beneficiary to another family member. But the real kicker? All that money grows and comes out completely tax-free when you use it for qualified education expenses. That's huge.
Okay, let's switch gears. We've talked about building up future value for school, but now let's talk about unlocking value in an asset you might already have right now. This is a financial tool for a totally different stage of life, and honestly, a lot of people have never even heard of it. It's called a life settlement, and it's all about accessing the hidden cash in a life insurance policy. So what exactly is a life settlement? Well, it's a deal where you sell a life insurance policy that you don't need or can't afford anymore to someone else. And in return, you get a lump sum of cash that's way more than you'd get for just surrendering the policy, but of course, less than the final payout. It's a way to get cash now from an asset that would otherwise only pay out when you're gone. The process itself is actually pretty straightforward. It breaks down into 4 steps. 1, you sell your policy to a provider. 2, you get your cash payment. 3, and this is a big one, the new owner takes over paying all the future premiums. You're completely off the hook. And 4, that new owner collects the benefit down the road. This is usually an option for seniors, say 65 or older, whose financial needs have just changed over time. Now, here's something you absolutely have to keep in mind. While a life settlement gets you cash right away, that money isn't necessarily protected. If you have any outstanding debts, there's a chance that creditors could make a claim on that cash. So that's a really critical thing to think about before you make a decision. Okay, so this whole thing isn't the Wild West. Not at all. Life settlements are actually highly regulated, and there's a clear rule book in place to protect you, the consumer. To get through this safely, you have to know who the players are and what rules they have to play by. To really get how the rules work, first, you gotta know who you're dealing with. There are 3 key roles in a typical life settlement deal, and each one has a very specific job to do. So here's the breakdown. The broker, they're on your team. They represent you and try to get you the best possible offer. The provider is the actual company that's buying your policy. And the intermediary, they run the platform where the brokers and providers all connect and make the deals happen. And this might be the single most important rule of all. Every single person or company involved, the broker, the provider, the intermediary, they all absolutely must be licensed. Checking that license is your first and honestly your best line of defense. You see this number on the screen? 2 years. That isn't just some random number. It stands for a really critical consumer protection rule called the 2-year prohibition. So what's it all about? Well, simply put, the law says you can't sell a life insurance policy within the first 2 years after you get it. This rule is there for a very specific reason, to stop people from buying up insurance policies with the only goal being to immediately flip them for a profit. That kind of thing could really mess up the whole insurance market. But the rules also get that, life happens. So if a major unexpected event happens in those first 2 years, like a serious illness, losing your job, a divorce, or a disability that stops you from working, you might be exempt from that 2-year waiting period. At the end of the day, these rules are designed to prevent something called STOLI. That's stranger-originated life insurance. This is when an investor who has no connection to you takes out a policy on you, pays the bills, and just waits to cash in. It basically turns a tool for financial protection into a pure gamble on someone's life. And it is absolutely 100% illegal.
So, beyond all these specific rules, there's a bigger idea that applies to good financial advice across the board, whether we're talking about life settlements, annuities, or whatever. It's the core principle of suitability.
And here's the main thing to remember about this. Good financial advice is never one size fits all. The whole idea of suitability means that any recommendation a professional gives you has to be genuinely in your best interest, tailored specifically to your life, your needs, and your goals. And to figure out what's actually suitable, a pro has to look at your whole financial picture, right? They need to understand how things like your age, your income, your experience with investing, and how comfortable you are with risk all fit together to make a recommendation that actually makes sense for your life.
And that really brings us full circle back to where we started. After looking at these powerful tools and the rules that keep them safe, it really leaves us with one last thought. Just understanding your options, from how you'll fund a dream to how you'll handle your later years, is the first and most important step to making smart choices whenever you hit a financial crossroad.